Hi, everybody. This is Alan Ellman, the Blue Collar Investor. Well, it's Sunday morning, March 22nd. We just completed the March contracts, and tomorrow, Monday, we're going to begin the April 2020 contracts. We're currently in the midst of a very challenging market situation because of the coronavirus crisis, which is taking over the global economy. Now, this particular situation gives me the opportunity to make a couple of points. And I'm going to share with you some of my very own portfolio trades to make these points. Number one, it's very important not to allow emotion into our trading decisions. I know it's very, very difficult to do, but it's something that will only benefit us in the long run. We must master the three required skills. And at this point in time, one of the most important ones is position management. So what I'm going to do with this particular video is show you some of the trades that I made during the March contracts to help mitigate the tremendous losses that the market has seen. So let's take a look at what's going on now with the March contracts, which just ended. The S&P 500 dropped from 33.38 down to 23.05. Yikes. That's a 30.9% decline. So if we own, for example, an index fund in the S&P 500, generally known as the market, we would have been down by more than 30%. Now, there's a lot of panic selling going on, for sure. Retail investors, even professionals, have allowed emotion to get into their trading decisions, something that I stress we should not ever do. Easier said than done, as we're watching our portfolio net worth plummet. But nonetheless, it will benefit us in the long run, absolutely 100%, if we stick to a structured plan. There are times we're going to lose money. We're not going to make money on every trade. And certainly in the last month or so, we've lost money. Just a matter of how much we're going to lose. So that's something that we're going to show you through the trades that I made. And I'll show you my actual broker statements. Now, the VIX, which is the CBOE volatility index, some people call it the investor fear gauge, which is generally inversely related to the market. So when the VIX goes down, the market's usually going up. In this particular case, the VIX has gone from under 15 to 66. Actually, it spiked in the high 70s a couple days ago. So that's a huge, huge volatility for the overall market, and of course a bad signal for our stock portfolios because, as I said, the market is generally inversely related to the VIX. So the VIX has gone up quadrupled, more than quadrupled, and so our portfolios will tend to move down as well. I don't have to tell you that. You already know that. And there's been huge spikes in the market almost on a daily basis. You know, it goes up one day a lot, it goes down the next day a lot. Now, for the most part, 30.9%, for the most part, it's gone down. But there are days when all of a sudden the market will be up 1,000 points, and you're thinking, well, maybe it's over. But it isn't. It has to retest the bottom, usually several times, and you also like to see selling volume drawing out. And this is something that I'm looking for in my own portfolio. I'll be happy to publish on the blog and in member reports and so on when my opinion is that the selling pressure is gone and it might be a good time to get back in. So currently I'm 50% in cash, but I want to show you what I'm doing with the 50% that's still invested. Now, our exit strategy arsenal is so important during these challenging market environments. I mean, thank God we have them. And they will include the 20%, 10% guidelines, which provide guideline thresholds as to when to buy back the short calls we sold for our covered call position. And those should be entered immediately after setting up a covered call trade. And I'm going to show you how I did that from one of my smaller brokerage accounts, and you'll see what it should look like. Then we can also roll down our options. If the price of the security is getting lower, we can buy it back and sell another option at a lower strike price, thereby generating additional time value premium. we could sell the stock. I did that. You'll see coming up shortly on certain securities that you just feel are underperforming, and you don't have a lot of hope they're going to recover. So you would just get rid of the stock and replace it with something else, or just move into more cash. I did both during the March contracts. And so, 50% is the amount that I'm comfortable investing in. But, for you, it might be more or less. So you have to make your own decisions on that. And very critical in this particular contract month was the implementation of the inverse ETFs. Now, every week when we publish our midweek ETF report for our premium members, page 6 always has a graph of these inverse ETFs. And on that page, I tell you that generally speaking, you're not going to be using these. I mean, because they move in the opposite direction of the market, and the market generally moves up. So it's rare situations when we're in a comfort level to use these. But this month was one of those times for me, and I'll show you exactly how I did it. So let's take a look at how I set up the trades initially before, all the market went down as much as it did. And you could see at the bottom here in the yellow cells, the securities I bought. Now this is basically my one of my ETF portfolios. So I bought 3 select sector spiders. They break up the S&P 500 into 11 different categories. So you see XLY, XLRE, XLU, XLK, the technology ETF, and then the Qs, which is which have 100 of the largest non-financial companies that trade on the NASDAQ exchange, mostly tech companies. So those are the ones I bought, and I broke it down based on cash allocation, trying to make it as close as I could. Can't be precise, but I didn't want one particular security dominating the portfolio, and that led me to determining, 100 shares here, 500, 300, and so on. Now, once I purchased those shares, I immediately sold the covered calls, which are in the brown cells on the top. So, for example, XLY, I had 100 shares, so I sold 1 contract. And then the actual premium less small commissions is on that far right column there. So that shows you the amount of premium that I generated. And when I use ETFs, my goal is 1 to 2% a month. This came out to about 1.5% initial time value return goal. So that was the initiation of my portfolio at the beginning of the March contracts, which started out at the end of February. Now, once you put those covered calls in place, you immediately set up buy to close limit orders based on the 20% guidelines. You change it to 10% halfway through the contract. So for example, you see here the Qs, which is in the top row over here. I put a limit order in to buy it back at 75 cents, which is about 20% of the original option sale of $3.75. So, and then we did that all the way down here, and those all represent 20% of the original option sale. So that was in place. So we're basically telling our broker, if the price of the option drops to this amount, this limit order or less, we all automatically want to buy to close, buy back that option. So we don't even have to be in front of our computers for that to happen. Well, guess what? It happened. And they were executed on all 5 of those positions. And I decided to sell them and move to inverse ETFs because the market was plummeting. And what I used the cash for was to buy 3 inverse ETFs. So I bought 1,000 shares of SH, which is short for the S&P 500. And I bought 500 shares of DOG, which is short for the Dow 30. And I bought 1,000 shares of PSQ, which is short for the Qs. So I spent the money and formed these inverse positions, which basically were going to go up if the market continued to go down. So here's the sale of the covered calls on these inverse ETFs. And you could see the cash, like for example, on these 1,000 shares, I generated $1.05 per share, $1,100. And then over here, on this 1,000, $700. And on this 500 shares, about $1,200. So all of them were executed, and I generated all this additional premium after closing down, after buying back the original calls, selling the shares, and then generating an additional premium from the sale of covered calls on these inverse ETFs. Now, what we do then is still put the 20% guidelines in place. So what we do is after we determine how much we sold the options for, then we go 20% of that amount and put in limit orders to buy them back at 20% of the original sale. Had we gone into the latter part of the contract and these shares were declining in value, we would change it to 10%. So 50 cents over here would change to 25 cents. 15 cents over here would change, you could either set it at 5 or 10 cents. This one over here, we would set at 10 cents. So if it went into the latter part of the contract, we would just change those limit orders to 10% of the original option sale from the original 20%. Now, what happened was we actually were able to hit doubles with two of these ETFs. Amazingly, we're able to generate more income. So what we did was we closed DOG and SH because they hit those limit orders. You could see here that we closed one at 20 cents and one at 50 cents. So the far right column shows us how much money I spent buying back these options. We spent about $460 altogether. Now that was on, take a look at this, folks. That was on March 3rd and March 4th, respectively. Okay, so the next day, the very next day, this shows you how volatile the market was. What happens? The market value starts to increase because the market went down. So the value of these went back up again, and we're able to resell those very same options for almost $1,100, over $1,100. So we spent $4 and change, and we received 11 and change. So we made nearly $600 additional income on hitting a double, buying back the short call and selling in the same call. Actually, it was the very next day. Usually it doesn't happen like this, where it's so volatile that you can hit a double from one day to the next. But this was just simply being prepared and taking advantage of one of our exit strategy tools. It wasn't luck. It was preparation and opportunity. That's what this was all about. So what happens? 2.5 days in the middle of the 18th of March, have a look at the trades that I executed on that day, just to show you that the volatility was so high that I was able to generate another 2% in premium with only 2.5 days left to expiration. Here's what I did. SH was, the option was deep in the money because share price had accelerated dramatically because the market had dropped so much. So I was able to buy back the shares, 1,000 of them, for $4.60. Now that seems expensive, but I was able to pay only 10 cents or so in time value because I was able to sell the shares, as you could see over here, for $31.49. And that was the 27 call. See it right there, the 27 call. So I sold it for $31.49. That means $4.49, a little more than that, was intrinsic value, increasing share value. So the actual intrinsic value was just between 10 and 11 cents. So I was able to buy it back at a time value cost of, let's say, 11 cents per share. And then I was able to purchase. I went back to the select sector spiders because the market looked like it was going to rebound. I purchased XLP and XLV. And then I ended up selling the calls on those and generating 600 and 400. So another $1,000 was generated. And this is the mid-contract unwind exit strategy in all my books and DVDs. But it's not mid-contract, is it, folks? It's 2.5 days till expiration. This is extremely rare because normally the time value erosion, or theta, makes it impossible to generate this kind of time value premium in most market conditions. But because the volatility was so incredibly high, I was able to generate another 2% in 2.5 days by using the mid-contract unwind exit strategy in the last 2.5 days of a contract. Very rare. But look, I was prepared. I knew what my exit strategy choices were. I was familiar with the option Greeks and the role that implied volatility plays in our option premiums. And the opportunity came by, and I just took advantage of it. All right? I didn't do anything that you folks couldn't do as long as you've mastered the 3 required skills. So let's just review my final results. I mean, I told you I lost money, but the fact that we sold covered calls, lowering our cost basis, and then used our position management skills, I lost a lot less money than somebody that just bought the market and did nothing. So the ETF portfolio value when the contract started was $101,654.52 and ended at $95,654.77, a 5.9% loss. Now, I'm not here to tell you that that's something that we should celebrate. You know, we lost 5.9%. That's significant. But if you look at the S&P 500 during that very same time frame, it started out at 33.38 and ended at 23.05, a 30.9% loss. So, you know, which would you rather have? A loss of 30.9% or a loss of 5.9%? Not rhetorical question, folks. So I just want to show you that when you're using covered call writing, which lowers your cost basis right at the get-go, along with our position management skill set, we can outperform the market pretty much all the time. In this particular month, it was magnified because of the huge volatility, and we actually outperformed the market by 25%, not annualized, in 1 month. So again, not allowing panic to take over, to remain calm, to follow our structured system, to understand that there are times when there may not be a good answer, but there's always a best answer. And in this particular case, the best answer allowed us to lose 5.9% rather than 30.9%. So in that regard, it was a happier outcome than for most people. So I wanted to share that with you because I've been getting so many emails from the BCI community regarding what to do in a challenging market like we have. And basically what I'm telling you is take advantage of the 3 required skills that so many of you have took the time to master over the years. Take advantage of that, and over the long haul, the story will have a happy ending. So I'll try to keep you posted on updates on the current market. I humbly give my opinion, along with that of the GMI and the IBD market assessment, plus your own. That should be the biggest factor. And then you could make your own decisions as how you're going to move forward in this very challenging market environment. So I hope you enjoyed this video. Perhaps there'll be more upcoming, but this is information that I hope you found useful. And there are better days ahead, folks, for sure. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.